Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, June 3rd, 2010. Let's start today's broadcast by taking a look at some market highlights, though we do have a good amount of US fundamental releases, which we'll get to at the second half of the broadcast. Here we take a look at the euro-dollar pair, and while the risk appetite appeared to return to the markets in Wednesday, boosted in part by strong data on pending U.S. home sales as well as a good showing from domestic vehicle sales, the modest gains for the euro were turned back at this 1.2325 level. And first we had tested the 50-period moving average around 1.2250, but then broke below that around 10:11 a.m. There was some offloading of riskier currencies in the New York session as the fundamentals missed expectations for the most part. Also, the euro was pressured by news out of Hungary, in that the managing vice president of Hungary's ruling party was quoted as saying that Hungary is facing a Greece-like sovereign debt crisis and will need crisis management measures. The new center-right government, which had promised tax cuts to boost growth, has warned that in the past few weeks that the deficit could be much higher than the agreed target of 3.8% of GDP, perhaps rising to as high as 7 or 7.5%. As many European banks have exposure to Central Europe, that pressured the euro. The euro weakness was also seen rather strongly in the euro-Swiss franc pair, which fell below 1.4120, a level that some had suggested would be one where the SNB would intervene to try to keep the Swiss franc from appreciating. However, we broke through that in a very strong candle and tested the area around 1.4050 in later New York trading. If we zoom this pair out, we see that the SNB did in fact intervene at the 1.40 level, so we'll have to keep an eye out to see if it decides to do so again if we reach that level. In the pound-dollar pair, we saw the pound sliding, similar to the euro, giving up some of its gains from yesterday's rally. Here in the Asian session, we were unable to move above our highs from yesterday around the 1.4750 level, and that resistance held, and from there we moved down to test our 100-period moving average, but also this 1.46 level, which was our resistance last week, but now is acting more as support. It's also the second time now in 2 days that the 100-period moving average has acted as support. Overnight, we saw strong gains in the Japanese stock market, and as well as bargain hunting during the European session, which helped boost equities there. The combination helped to push the dollar-yen pair higher to the 92.80 level in overnight trading, but then turned back down during the New York morning session as we saw U.S. equities in the red for a while. Then we tested our resistance from yesterday's session at the 92.35 level, and it acted as support, and we rallied again in the later part of the New York session as we had equities stage a rally as well as oil prices. Overall, in this pair, we see that the greenback continues its gains that were started back here on May 25th. Taking a look at the Australian dollar US dollar, we saw that Aussie rallied overnight as we had a rather strong trade balance report, as well as higher equities in the Asian session, as I mentioned. We reached a high of 0.8520, but then as we had traders begin to take risk off the table, we saw the pair decline, testing this area around 0.8360. That came close to our 200-period moving average in 1-hour candles, and also a Fibonacci retracement of this 2-session upswing of this, where we tested the 61.8% retracement for the pair. With the U.S. stocks making a rally attempt in late New York trading, the pair did have a second rally here following the test of support. Taking a look at the Australian trade balance report, we had a surprise in that we posted a surplus for the first time in 14 months. The surplus amounted to 134 million Australian dollars. Exports rose 11%, but that included farm goods. Taking food out of the equation, exports ripped off an impressive 18.4% increase, the biggest since May of 1982. The jump was led by a 25% increase in demand for metal ores, including iron ore, and a 40% jump in coal shipments. And the report reaffirms that China is still very hungry for Australian resources despite the government's efforts to cool its economy, though mainly its focus is on its housing bubble. Surpluses for the Australian economy in terms of its trade balance will benefit the Australian dollar going forward. And a look at our final market highlight is the US dollar Canadian dollar, another one of our commodity currencies closely linked to global growth. And in today's session, we saw it pair the declines or the gains in favor of the Canadian dollar in the overnight session as we came back to test our short-term and medium-term moving averages at the 1.0450 level, which also corresponded to a Fibonacci retracement of around 50% of this down move over the last two sessions. Oil prices did manage to stage a late rally, which helped the Canadian dollar to gain back to near the 1.04 level by around 4 p.m. Eastern. Now, we did have some risk aversion in the early New York session as U.S. data yielded a mixed bag of results. The reports generally missed expectations, which led the dollar to strengthen against its counterparts as investors took money out of riskier assets and moved them back to the safe haven greenback. That was at least prior to the New York afternoon session. So let's dive into those releases. Private sector jobs in the U.S. increased by 55,000 in the month of May, according to the ADP Employment Change Report. Expectations had been of a 70,000 increase. Taking a look at the data, we see that goods producing sector lost 23,000 jobs, while the services sector added 78,000 jobs. In a second report from the labor market, the Labor Department said that initial claims for jobless benefits fell by 10,000 to 453,000 the week ended May 29th, which was a slightly larger decrease than expected. The figure puts jobless claims in the middle of its range we have seen over the past 3 months if we take a look at the data at the chart to the right. It was the second week in a row that claims declined, and as we have seen the economy adding jobs in the past few months, it seems that this level, around 450,000, is consistent with job growth, but it is still at an elevated level. In a third report from the labor market, non-farm business labor productivity rose at a seasonally adjusted annualized rate of 2.8% in the first quarter compared to the first 3 months of 2009, when it rose 6.9%. The 2.8% figure was weaker than the preliminary version, which showed a 3.6% rise. What the figure suggests is that many firms may be reaching the limit of how much extra input they can get out of their fewer workers, which should lead to more hiring in the months to come. As we can see from the chart to the right, the last 4 quarters have seen very high productivity increases, but in the first quarter, we've seen a rather significant drop-off from the previous 3. The U.S. Services sector expanded at the same brisk pace in May, which was the same strong growth we had seen in April and March. The ISM non-manufacturing index posted its third straight reading of 55.4, the fifth month of expansion, but it was weaker than expectations of a reading of 56. The internals showed rather strong business activity, new orders, backlogs, and the employment subindex moved into positive territory, posting a 50.4, which was the first increase in the subindex during the recovery. So again, while a good report, it did slightly miss expectations. And in our final release, factory orders for the month of April rose 1.2%, which was lower than expectations of a 1.7% increase and also lower than the March reading of 1.7. Looking at the chart to the right, we see that the annual change of new orders and shipments are forming a V-shaped or maybe a U-shaped recovery in manufacturing. And as we've noted throughout our broadcast of the past few months, the manufacturing sector has been spearheading the U.S. recovery as inventory rebuilding boosted output in late 2009. The ISM manufacturing index earlier this week showed a strong reading for the May period of 59.7, implying the momentum in the sector remains. So overall, the data was solid, though the pace of recovery no longer seems to be accelerating. And since we did miss expectations somewhat, the New York morning session was filled with the greenback actually gaining on some risk aversion. So that is our roundup of the U.S. news. Let's see what important events, fundamental releases we can expect in the coming session. Overnight, Euro will post its revised GDP for the first quarter, and tomorrow we get first the Canadian employment change and unemployment rate at 7 a.m., which is followed by the ever important non-farm employment change at 8:30. Tomorrow's non-farm payroll report is expected to show an increase in jobs of over 500,000, though many of those will be temporary government census jobs. Therefore, the important factor to look out for will be the number of private sector jobs that are created. Still, such a big headline figure will mean extra income in the pockets of households, and hopefully, for the sustainability of the U.S. recovery, will mean an increase in consumer spending. We round out tomorrow's data with Canadian building permits as well as the IBPMI. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site at cmsfx.com. I want to thank you for watching and wish you good trading.